Good afternoon and good morning. Welcome to Treasury Strategies Quarterly Cash Briefing for the UK, Eurozone, and North America. I am Moni Lindsay, Managing Director and Head of the London office at Treasury Strategies, and I'm joined on this call by Tony Carfang, Partner of Treasury Strategies. And we are particularly excited today to be joined by a panel of distinguished guests whose organizations are also sponsoring this event. Martin O'Donovan from the Association of Corporate Treasurers here in the UK, Debbie Cunningham from Federated Investors, and Scott Horan from PNC. I'll provide further background on our panelists before the panel discussion. For those corporate and banking clients joining us for the first time, a bit of background on these briefings. Corporate liquidity has long been a significant aspect of our consulting work, both for corporate and bank customers of Treasury Strategies. We became concerned several years ago when the subject of cash hoarding kept coming up, particularly after the release of central bank quarterly reports of cash levels, whether the Bank of England, the European Central Bank, or the Fed. So we decided to start digging into it and understand what's really going on at a deeper level. And we have done this through surveys and one-on-one discussions with our clients, and by studying growth trends and cash levels based on the quarterly central bank reports. Since we began our surveys and these briefings, the focus on cash has only magnified. Today, we're pleased to share with you our latest findings. A word before we get started. Our 45 minutes today gives no time for Q&A. However, we want to take your questions, so please type them into the question box in the bottom right-hand corner of your screen, either during or at the end of the webinar, and we'll circulate the answers to all who have called in. A quick preview of the next 45 minutes. So Tony is going to share the latest reported cash levels. Then I'll review key highlights from our recent survey of corporates. Then Tony will briefly discuss potential game changers to the deposit landscape. And then we'll have our panel, and we'll wrap up soon after the panel. And now I'm going to turn it over to Tony. So Tony, what are the latest reports from the central banks telling us?
Cash is up. As you can see from the chart, the growth in corporate cash increases. It actually slowed a bit in the 2010-2011 period, as you can see from these charts. However, in the most recent 2 quarters, we've seen cash tick up in the U.S. In the most recent quarter, we've seen it move up in the U.K., and we've seen a slight uptick in the Eurozone as well. As cash has increased, it's kind of interesting because this doesn't seem to be simply a pre-crisis phenomenon. Cash has been increasing since the turn of the millennium, and in fact, in the middle of the last decade, pre-crisis, we saw some big increases in cash. A couple of interesting things here. It's been a year since the U.S. Federal Reserve revised its statistics as it reported corporate cash. As we began shining a light on this and showing cash as a percentage of GDP 11 quarters ago now, and about a year ago, the Fed actually revised the U.S. cash number downward by $1/2 trillion. And we still have no adequate explanation from the Fed as to what the nature of that adjustment was. The only response we have is a footnote from the U.S. Federal Reserve that said this is based on better data from the U.S. Internal Revenue Service, which of course has absolutely nothing to do with measuring corporate cash. So we're still awaiting the answer. What's even more interesting, though, is we now get word that the Office of National Statistics in the UK is reviewing their methodology, and we expect a downward revision in the UK corporate cash number coming up in the upcoming quarter. Apparently, the UK believes that the numbers they're reporting include trust or financial institutions of some form or hedge funds that are inflating their numbers. So it's kind of interesting, as we've been reporting this now over the last 11 quarters, central banks seem to be a little bit sensitive to what we're saying. Yeah, this next chart shows how the UK has actually been an outlier in terms of the trends in corporate cash. So perhaps an adjustment is in order from the ONS. One thing that's interesting to look at here is how closely the Eurozone and the U.S. have trended, and I suspect after we have the revised numbers, the UK will trend as well. So it's not as if a couple of corporate treasurers have said, "Hey, let's hoard cash." There seems to be a higher cash levels seem to be the way the companies are managing risk and uncertainty. And it doesn't appear to be some nefarious plot on the part of corporate treasurers. When we look at cash as a percentage of GDP, we find in the U.S. for the last dozen or so years, it's been relatively flat. It's increased from 10% of GDP to 11% of GDP. So in some sense, you can say this is the level of cash that's actually required to conduct business. In the Eurozone, the numbers grew from 14% to 20%. Frankly, that's not a surprise because you have much more fragmentation across countries. You have a little more difficulty in pulling all the cash together in a single cash pool and employing it. So you might expect a somewhat higher cash level. Again, the UK has been an outlier. We actually believe the corporate cash is higher in the UK simply because that's where a lot of global companies tend to concentrate, and that's where a lot of European countries tend to have their European cash pools reside at the end of the day. Now, to take a slightly different look at things, we've been showing you for the last several briefings the level of reserves held at central banks. And we continue to want to show you this because it illustrates the level of intervention that is going on in the markets and perhaps why quantitative easing might be a fool's errand on the part of central banks. Again, if you look at the top left, in the U.S., bank reserves at the Fed had been flat at relatively $40 billion. This chart begins in 2006. You can go back to 1995 and it's still $35–40 billion. Fairly flat, absolutely stable, and then post-crisis, as we had stimulus and quantitative easing, these numbers have reached gigantic proportions. And in fact, the latest quantitative easing program, whether you call it QE3, QE3.5, QE Infinity, whatever you choose to call it, the Fed is now purchasing another $85 billion a month worth of government bonds, and so this number can only go up. We see similar trends, although in the last couple of quarters they've ticked downward at both the Bank of England and at the European Central Bank, but in both cases a significant multiple of what the numbers were pre-crisis. And much higher volatility as to what the numbers were pre-crisis. And in fact, in our consulting practice, as we talk to CFOs and treasurers, what we're hearing, and the reason we think the quantitative easing might be a fool's errand, is that CFOs are now saying there is so much intervention in the markets, we don't know what the real cost of capital should be. We don't know what a longer-term investment should be returning to our corporation, and as a result, we are not investing the cash. It's as if this massive amount of intervention has taken away an important signal, an important market signal back to corporate treasurers. Now, let's turn the page. We have some interesting things here. We've decided, so for the first time, we're adding charts from the Bank of Japan and the Swiss National Bank. And let's focus on the top left here. The Bank of Japan, the reserves have gone from 5 trillion yen to over 40 trillion yen. So percentage-wise, the increase in reserves has been nothing short of phenomenal over the last several years. And now, just this morning, the Bank of Japan has announced a massive quantitative easing program. So if you see that number up there at 45 trillion, keep that in perspective. The quantitative easing program they announced today is for 140 trillion yen. 140 trillion yen on top of this massive expansion. I mean, the level of intervention here is is nothing short of staggering. On the top right, we mentioned in the last briefing that we saw some interesting cash movements going on in Switzerland. So we did a deep dive on there, and sure enough, we see huge increases in reserves at the Swiss National Bank. What's interesting about this, you see the total reserves at the Swiss National Bank of about 500 billion francs. Total reserves at the European Central Bank are only 700 billion euro, yet the GDP of the Eurozone is so much larger than the Swiss Central Bank. So proportionally, this number is huge, and this is obviously the result of the Swiss Central Bank trying to peg the value of its currency. Again, though, just another example of massive intervention. On the next chart, a quick example from the U.S. At the end of the year, the unlimited deposit insurance at U.S. banks lapsed, and the two charts on top show that even though insurance lapsed, we did not see a massive outflow of deposits, nor did we see a massive outflow or inflow of monies into money market funds, which would be the logical expectation if you believe that the markets, corporate treasurers are saying that deposit insurance is important to us. I think these two charts on top are the biggest piece of evidence that says the too big to fail mentality is totally ingrained in everyone's mind, and not just for the largest banks. As you can see in the table, deposits are up in the U.S., again, this is a U.S.-centric example. Domestic banks, foreign banks, large banks, and small banks have all experienced an increase in deposits as deposit insurance lapsed. One last point before I turn it over to Moni. Obviously, we have an important situation playing out in Cyprus, and so and what we hear on the news is part of the problem is that the banking system in Cyprus was so large relative to the size of the Cypriot economy. So we decided to ask, we asked the question, well, what's it like in other countries? And what we see on the next chart are bank assets country by country as a multiple of GDP, and we have this for a sample of countries. This is absolutely staggering. You can see Cyprus third on the list at with total banking assets of about 7 times its total country GDP. The range goes from 0.7 in the U.S. up to over 22 in Luxembourg. Not sure what all this means, but it's got to mean something, and we're going to be digging into this and talk more about it at our next cash briefing. But we thought these numbers are fascinating. If you have any thoughts, please email us. We'd like to really dig into this. Now, let me turn it over to Moni, who will discuss with you what our corporate treasury clients are telling us about how they're managing their cash.
Thanks, Tony. So before we go to we're on that slide now, but just a bit of background on the survey. So we conducted the survey over the web, and we received over 200 responses globally, but the concentration of the responses were from the UK, Western Europe, and US. So it really speaks to our focus today. So we asked the survey respondents about the expected changes to cash levels in the next 6 months. And of note is that 44% expect balances to increase in the next 6 months, up from 35% last September, and a comparable decline in those that expect to remain the same. Now, we suspect companies are expecting increased cash flow from operations without a commensurate increase in spending, and this is really very much aligned with what Tony was talking about. They're not quite sure. You're not quite sure about what your cost of capital is, so capital expenditures, acquisitions, et cetera, are a bit tougher to justify. So let's look at the sources and uses of cash from the survey participants. So next slide. So if we look at sources, and here we show the sources of cash year over year from September 2010 through September 2012, and then from March 2013. Positive cash flow from operations is still dominant, but leveling it out at just under 80%. The reduction in inventories is down as most companies have optimized their cash from working capital efficiencies, which we suspect was partially behind the reduction in inventories as a source of cash 3 years ago. Now, if we look at the uses of cash, negative cash flow was the biggest use of cash in the first year we started surveying, but clearly taking a back seat to capital expenditures. Do note that there's an increase in dividends, and we have been hearing from our clients that they're getting pressure from their boards to spend some of the cash they've been accumulating, whether it's in dividends or acquisitions. So perhaps that's part of the story we're seeing here. And then we also asked about managing risk, always top of mind for our corporate clients. There's almost no change in expected maturity structures or in hedging of FX exposures, but a noticeable increase in companies that expect to be less conservative with credit risk. So it'll be interesting to see how that gets reflected in the next survey and the next quarterly cash briefing, and we'll share that with you. Now, turning to slide 15, there are really no surprises here. We think it's important to understand how this deposit landscape is impacting the changes to Treasury management practices, so we asked them about that. Again, no surprises. We're seeing what we've been seeing. So with the continuing focus on liquidity and the economic uncertainty, it still behooves every company to have their hands on the pulse of their current and projected liquidity needs. So forecasting is critical to that. And here we see 50% are increasing reliance on forecasting. The percentage of companies expecting to implement new technology is up, still not at the 2010 level of 43%, but very much in line with what we're seeing with our corporate clients. With more cash than ever to take care of, it makes sense that treasuries are turning to technologies to assist them in managing of that cash. And then increased technology investment also goes hand in hand with increased reliance on forecasting. But perhaps the broader trend, accelerated by the crisis, is that Treasury is playing a far more critical role within the firm, what we call Treasury 3.0, where Treasury has been positioned as the financial nerve center of the organization with a much broader remit than in the past, and responsible for liquidity and all that entails, monitoring and managing risk. Counterparty risk is certainly top of mind for everyone we talk to. And then technology is really critical to being able to effectively execute that role as the financial nerve center. Finally, policies, investment and risk management. There's not significant change, although there is an increase. It's going up to 19% that are taking a look at their policies. Certainly, right after the crisis, everyone was looking at the policies. And we've seen a major focus on modifying risk management policies. And I think what we're seeing here is that there's an ongoing level of focus to make sure policies remain relevant for the current environment. Every news event and downgrade can trigger a request to revisit policies. So Tony, what do you see on or what do we see on the horizon that would significantly change the deposits landscape?
Well, Moni, there are a number of game changers. We were talking about the too big to fail phenomenon, and we're seeing among regulatory bodies a renewed interest in figuring out how big a bank should be and what they can do to ensure that the banks don't exceed that size. But it's really hard to tell how that's going to play out. But we're going to be talking about that in a minute. Deposit insurance, as we illustrated, when in the U.S. the FDIC eliminated its unlimited deposit insurance, there was barely a whimper. Now we have the situation of potential bail-ins in Cyprus. In fact, I saw a cute cartoon in a London paper the other day that showed a bank robbery in progress, and it was the teller who was holding the gun. Quite a reversal. The monetary policies of central banks, and we just saw 140 trillion yen being injected over the next 2 years by the Bank of Japan. That there's such a hammer hanging over the financial markets with the grossly inflated balance sheets of the central banks. Extraterritorial regulatory reach. We heard a lot about this a couple of years ago. It was quiet, but now it's very subtly taking shape as regulators are claiming jurisdiction over their headquartered financial institutions anywhere in the globe that they happen to be doing business. Other regulators are claiming jurisdiction over any transaction that happens through a party related to their country in some way. And we think we're about to enter a period where folks are going to be tripping over, regulators are going to be tripping over each other, claiming jurisdiction. That would obviously be a concern for any global corporation or any global financial institution. The next chapter, money market fund reforms. The FSOC in the U.S. issued an admonishment of the Securities and Exchange Commission and says you go back and come up with some better regulations, and we're kind of waiting to read the tea leaves on that one. Meanwhile, the European Commission is expected to release some proposals in early May. So that saga continues. It's been dragging on for 4 years. And it creates a level of uncertainty in the market. Transaction taxes, we've seen a number of proposals. Obviously difficult to work out, what is a transaction that needs to be taxed, what's a transaction that doesn't need to be taxed. In the state of Connecticut in the U.S., the legislature has actually taken up a bill to tax excess cash of corporations headquartered in Connecticut. Now, how the heck you figure out what excess cash is and how you're going to tax that is certainly beyond my pay grade. However, we have some folks here on the panel, and this is not beyond their pay grade. So to talk further about these game changers and other important issues, Moni, could you introduce our panelists?
Yes, Tony, thanks. So we are thrilled to have our panel with us today. So let me tell you a little bit more about each of our panelists. Martin O'Donovan is Deputy Policy and Technical Director at the Association of Corporate Treasurers, where his responsibilities include provision of technical guidance and regular updates to their members, as well as representing the views of treasurers to government, regulators, and standard setters. The ACT is a professional treasury organization headquartered in the UK, but with members globally and delivering international qualifications globally. Debbie Cunningham is Executive Vice President, Senior Portfolio Manager, and Chief Investment Officer for Taxable Money Markets at Federated Investors. Federated is a leading investment management firm and a pioneer in money market and fixed income funds. Scott Horan is a Senior Liquidity Management Executive at PNC, a leading financial institution. He's responsible for short-term cash investment products, including PNC Bank liabilities, and various third-party money market funds used by Treasury management clients. So, Tony, what questions do we have for our panel?
Oh, we have a number of questions, and let's just begin in order the way we're listed here on the page. So, and begin with Martin. Martin, could you tell us what you see as some of the most impactful regulatory issues impacting your corporate treasury members, and how you're helping them deal with them?
Yeah, sure. Well, actually, looking back at your slide on those game changers, a lot of the things that are coming through on regulation are driven by concerns over counterparty risk, making the financial system safer. And one of the things that we've seen that's going on is that a lot more of a bank's funding is being secured. When banks borrow short-term liquidity from the central banks, it's secured. When they borrow long-term funding, they very often use covered bonds now. And even the interbank market's dying out, so that instead they're using secured deposits. That's dealing in repos. And again, in the derivative market, we're seeing the moves there towards everything being collateralized through a central counterparty. So what this means is that wholesale deposits that non-financial companies make with their banks is about the last unsecured form of funding for banks. And then we just had in Cyprus that some depositors being bailed in and effectively losing some of their money in the sort of waterfall that takes place. So, you know, the big concern is counterparty risk, and as to mitigate that, companies are starting to look at placing secured deposits with their banks, actually doing repos.
That's fascinating, Martin. And at some point, there may be a shortage of collateral to back everything that is now requiring collateral.
That certainly has been mentioned as a concern, yes.
Excellent. Now, Debbie, from your perspective at Federated and running some of the largest money market funds in the world, what regulatory issues are impacting your clients?
Obviously, the largest one would be centered around our industry, which is the money fund industry and money market fund reform part 2, both in the domestic U.S. as well as in the offshore marketplace. And essentially, we're optimistic in the current environment about that largest concern just because of the change of personnel that's essentially occurred over the course of the last month and a half or so. With Mary Jo White, yet to be confirmed, but most likely replacing Chairman Shapiro and Elise Walter at the SEC, we feel there's a whole lot fairer picture that will be painted of the industry under her tutelage than had necessarily been the case under previous leaders. And then certainly the change from an FSOC perspective driven by the Treasury side of the equation with Chairman Geithner being replaced by Chairman Liu, we also think is a positive towards the more retrospective and fair assessment of how that money fund reform will continue.
So certainly the personnel changes raise a question mark, but you sound fairly optimistic here.
It can't get worse.
Okay, great answer. You're absolutely right about that. I mean, there's nothing that markets hate more than uncertainty. Now, Scott, you're out and about in the market every day as head of liquidity for PNC Bank. You're dealing with corporate treasurers, and I know from our conversations, you're talking to them daily about what's happening with their deposits and their treasury management. What regulatory issues are top of mind for your clients?
Yeah, Tony, I think that the things that are going to likely be most interesting from an impact to corporations is really kind of what's happening from a regulatory perspective for the banks. If you think about Basel III and the liquidity coverage ratio, that will influence banks to treat the types of deposits differently that a corporation may leave at the bank. So not all deposits are created equal on a go-forward basis, and it will depend on not only the segment that the deposits come from, but as well what those deposits are designed to do, whether they are there to support the operating business that particular corporation does with that financial institution, or whether it's purely for investment purposes.
Very interesting. So your clients are watching these issues, and I assume that they're concerned about how the banking industry is going to respond, since bank loans and deposits are their lifeblood.
Certainly. I think that what's happening today, these rules aren't final, especially here in the U.S., but there is some expectation as to the direction they will take, and I think that all of the U.S.-based banks are very much preparing and starting to head in that direction. And as you start to go down that path, you start to make judgments around the types of deposits that you would prefer to have on your balance sheet. And therefore, that influences how you will approach your customers relative to the deposits that they have to place with you, and what you will take and what you will pay, and all of those considerations come into play at that moment.
Interesting. Let's shift gears for a second and go back to Martin. The first several slides showed the increase in corporate cash. It showed a tremendous amount of central bank interference in the markets. Clearly, the central banks are playing a huge role globally as we try to recover still from the financial crisis. Which central bank policies, Martin, do you think are the most critical? And for the corporate treasurers who are on the line today, Martin, what do you think they need to keep their eye on in terms of central bank activity?
Well, I suppose it's the effects of QE and supplying liquidity to the market in that we're in this incredibly low interest rate environment. And it's not just short-term interest rates, it's longer-term interest rates, as I think you mentioned earlier. What that means is that there are an awful lot of companies who are perhaps surviving the recession and the sort of general downturn simply because their interest bill is not as high as it would otherwise be. That raises the risk that at some stage, if interest rates start rising, inflation starts coming back, those companies are really going to suffer. And so basically companies across the piece need to be thinking about how would they cope with those rising rates, because there could be a far greater slew of corporate failures. And perversely, once the economy starts moving forward, companies need more working capital, and if that's not available or becomes expensive, that can be the very thing that triggers failure. So it's great while it lasts, and perhaps if you are a borrower, it's an opportunity to grab the moment and what availability and what rates there are.
It's fascinating, and my attention peaked when you said there are a number of companies who are staying afloat simply because interest rates are so low. You might say that about some sovereign entities as well.
That's true, but they're the ones who have the control over the rates.
The Machiavellian instinct would suggest that maybe some central banks need to keep the rates low in order to finance their government debt.
You might have noticed that within the Basel rules, there is a requirement for banks to hold liquidity, and some of that happens to be sovereign borrowings.
Debbie, you obviously watch global markets day in and day out. What activities of central bankers do you and your clients look out for?
Well, I would agree with Martin on the QE side of the equation, and I think in particular it's how, with all of the massive interventions that have been undertaken by not just the U.S. but obviously other central banks, how that reversal or unwind process is undertaken. Going back to one of the things that Martin said in the regulatory issues discussion is counterparty risk and certainly collateral. If the collateral remains on the balance sheets of these central banks, as I think it will in a reversal situation, certainly at least in the U.S., that continues to pose problems from a market perspective with a supply and a demand imbalance. So, I think how the unwind process is noted, is it a diminution of the monthly purchases? Is it a complete cessation of the monthly purchases? Is it an open-ended statement that says we're going to skip it this month and we'll see what next month brings? I think all of those will have keys as far as indicators and sort of assessments about the health of the economic situation that we're undertaking. And then finally, as far as the actual unwind itself, I personally don't believe that you're going to see those bonds come back into the marketplace probably over the course of the next, anything less than the course of the next decade or so, as sort of natural maturities and pay downs occur.
It's kind of ironic, Debbie, that the money fund industry is under attack for maintaining a balance sheet that basically aggregates investor overnight funds and deploys them into 30-day commercial paper, yet we see the central banks around the world taking overnight bank reserves and deploying them into 20-year bonds.
Exactly, and all being done under the guise of monetary policy.
Right. Scott, from your vantage point and with your corporate clients, what do you advise your clients to keep their eye on as they're managing their treasury, particularly with respect to the activities of central banks?
Tony, I think that both Martin and Debbie have kind of talked about the same things that I would talk about. It's the great unknown. It's what happens. We've never been here before, so nobody knows what's next. How do we get from here to a normal environment? And I think that that's really the concern that I see that corporations and treasurers have around these central bank policies. They just don't know what's next, which kind of leads back into some of the things that you were talking about throughout the presentation as to why corporate cash is as high as it is. It just creates an extension of this uncertainty that people don't know how this is going to work itself out, and therefore they may not make decisions that they otherwise might.
Great. Let's reverse the order here, and we'll, for the next question, start with Scott. Again, have you seen any major deposit flows or changes in your corporate customer behavior as a result of the expiration of the deposit guarantees in the U.S., or even more recently in the last couple of weeks because of the uncertainty around Cyprus?
Tony, the expiration of the unlimited insurance in the U.S. was pretty much of non-event. Seemed like across the board for both banks and investment houses. I didn't see a whole lot of change take place because of that. It seemed like everybody was under the expectation that was going to happen, and we did a lot of communication with our customers around what their expectations were, what they might do. We did a lot of internal communications so that everybody internally understood what our customers were telling us, and we kind of tracked that. So it was relatively minor reaction, some tweaking on the edges here and there from a few customers, but generally not much change or difference from what they had been doing relative to the deposits they held at PNC. Relative to Cyprus, we haven't seen anything at all come out of that event. No change in customer behavior, no change in the customer's positioning that we can tell. Certainly, my perspective on that is that they had already done much of that positioning and didn't believe that they would be impacted by Cyprus from that perspective anyway. So they weren't. It wasn't an issue. Certainly, the potential for contagion actually was a point of discussion, but given that didn't occur, nobody really needed to do much.
Excellent. And the first central bank statistics we're going to see come out tomorrow afternoon that will be published in the U.S. by the Federal Reserve, and that will show total bank deposits for the third week of March, which is the one we're keeping an eye on. Now, Debbie, has your experience on the money fund side been the same? We're hearing Scott say that it's been pretty benign.
Yes, a lot of discussion with very little action. If we look at your chart again on page 8, I think it is, of the presentation, Tony, Federated experienced a little bit more inflow or positive net change during that time period of October 2012 through March 2013, but necessarily we can't equate that back specifically to the expiration of the tag account. So, we think that there was a lot of year-end sort of positioning involved in those increases in assets too. I think probably with the Cyprus situation, it'll be interesting to watch this chart the next time that you are providing it, because the expectation would be the very bottom line on that chart, the small deposits, would have a larger degree of outflow, or at least a smaller degree of inflow, in the concern over what has been happening on the bail-in situation with Cyprus and what the potential impact may be on other banking institutions in other venues. Now, again, that takes a leap of faith, assuming that the underlying customers of those small bank deposit accounts are even aware of the Cyprus situation, and we certainly have not been getting a lot of customer inquiries about it, but it naturally could flow in that direction.
And Martin, are you getting a number of inquiries from your members regarding the Cyprus situation and the implications?
I think I'd pretty much agree with the other two panelists there, and the one I can comment on is Cyprus. And I guess within Europe, corporates have already, well, for some time, been taking quite a cautious attitude towards balances held with Eurozone banks. So, you know, fine, Cyprus has happened, but I think, in a sense, they had already prepared for that sort of thing.
Excellent, excellent. To kind of wrap up our panel, I'd like to go around with one last question, which is sort of what else is keeping your clients up at night, and how is your institution helping them cope? Scott?
Thanks, Tony. I think that generally the concerns that we hear are keeping up to date and track of all of these various things that are occurring, whether that's money fund reform, Basel III, Dodd-Frank, Cyprus, the tag expiration, you know, all of those kinds of things in total seem to be a bit daunting to keep track of and understand the potential impact. And I think that how we are addressing that and how we are helping our customers is through the communications that we have and providing our perspectives, actually meeting with customers on a regular basis. There's a whole team of people available to talk to our customers around our views on these events and how they might impact that particular customer. So I think that is the primary thing, and it really boils down to their risk management practices and how they manage counterparty risk and the safety of their short-term cash. And I think that the approach that we take is very much an effort to discuss the various events, our perspective on those events, and what is available to the customer from a PNC perspective in order to support the practices, the risk management practices they need to deploy, as well as how to assess the appropriate positioning of their short-term cash.
Very good. Debbie, are there other issues that you're hearing from your clients that we haven't discussed yet?
No, three broad categories in the order of regulation, low rates, credit. We've touched on all three of those. We mitigate or try to address these with the client by improving our disclosure and communication. So very similar to Scott's answer.
Wonderful, wonderful. And Martin?
Well, if I could just briefly move a little bit off the subjects we've been talking about. I mean, the thing that is really keeping treasurers awake for the moment is derivative regulation, because you know that's a specific new regulation that's coming along and is being implemented right now. So companies in Europe are having to get used to that. Certainly the ACT's tried to help. We've issued a briefing note that's available on our website, but it's now a lot of admin and work for treasurers to get down and do.
Great. Thank you. Well, this has been very informative. We could probably go on for an hour. And actually, for the rest of our audience, this particular panel was bantering for quite a while before the webinar began about all of the happenings in the financial markets. Let me move forward to key themes that have emerged from Treasury Strategies work with our corporate clients, and some of the advice we're giving our clients. And clearly, you know, this is all about information flow and ensuring global visibility of your cash and risk. And I think, you know, we heard that from our sponsors as well today. Companies are taking advantage of the low rates to strengthen their balance sheet. many of our clients are going through organizational assessments to find, what the most efficient way is to execute Treasury in this environment. They're building a roadmap to Treasury 3.0, with corporate Treasury being the financial nerve center of the firm, and for the most part, avoiding temptation to chase yield. And I say for the most part because I got to tell you, with 10, 20 basis points of opportunity, you have to go pretty far out on the yield curve and be taking a fair amount of risk in chasing yield. So that's pretty much what we see from Treasury Strategies perspective. Moni, would you like to summarize for everyone?
I would. Yes, I want to thank you again for joining. This is our 12th quarterly cash briefing, and a special thanks to our panelists, Martin, Debbie, and Scott. Look out for our invitation to the briefing next quarter. And also for corporates on the line, be on the lookout for our next survey and take a few minutes to complete it. Your input is very important to the ongoing assessment of trends and impacting cash levels. Thank you, too, for your questions. We will answer and circulate to all who have registered, and we'll also send you a copy of the report. We encourage you to look at our sponsors' websites and our website for further articles and commentary, and to reach out to us if we can help you with your liquidity, forecasting, or technology strategies as you navigate these continued uncertain times. Thank you.